Good afternoon, everybody. I'm Matt Dimitroshin. I'm the Director of Investments here at Telemus Capital. Want to welcome you all and thank you all for taking time out of your days to join us today. We're going to talk about the economy and in particular the economic impact of the COVID-19. We're actually fortunate enough today to have Mike Bazdrich, sorry, Mike, here. Mike is a senior economist with Western Asset Management. Western, if you're not familiar with them, is among the largest bond investors in the world. Mike has 42 years of investment experience and for the last 15 years has been with Western Asset Management. Mike has a PhD in economics from the University of Chicago. And Mike, I've actually even heard a rumor that you studied under Nobel laureate Milton Friedman, if that's correct.
That's correct, under Milton and about 10 other Nobel Prize winners. Wow. So it's a nice experience.
Good training ground for you. And we appreciate your experience and taking time to be with us today. I think the format today, I've got a bunch of questions on my mind that I just wanted to throw at Mike and get Mike's perspective for all of you. There is an opportunity to ask questions. So if you have a question, click on the Q&A box and type in your question and we'll try to get to that at the end. I guess, Mike, to start off the discussion, if we just kind of think more broad strokes, right? We know the coronavirus is going to have some economic shock to the economy. Just what do you see as kind of the most significant ramifications on the economy from the coronavirus?
Well, one off the top, Matt, and just to kind of extend the point you're making, I mean, I'm sure our listeners have heard projections all over the place. I've heard numbers as much as minus 40% for second quarter GDP data, GDP growth. We're not that low. I don't think that's unreasonable. One thing you got to keep in mind with these numbers, they're all multiplied by 4. So these are annualized rates of growth. So if the economy declines 5% in second quarter, it's going to get reported as minus 20. So the people that are looking for minus 40 are really looking for a 10% drop in second quarter alone, which again is possible because some of the sectors we're seeing are shutting down completely. You know, airlines, 90% shut down. Hotels, it looks like something like 80%. First off, or second off, so the areas we're talking about most affected, airlines, passenger travel, hotels, restaurant, and recreation, spectator sports, golf courses, bowling alleys, and theaters, they represent about 7.5% of the economy. Okay, if they were to shut down completely in second quarter, that would be a minus 30% hit to GDP. It's not going to be that big, but you know, who knows? We'll see how big the shutdown is, and then more important too is how long it lasts. The hits to these leisure-oriented service companies, about 7.5% of GDP, are going to be huge. What we don't know yet is what the hits are going to be like to manufacturing. Other areas where not necessarily going to be shut down, they're not affected the way airlines are, but still because of shelter-in-place orders and social distancing, you might have to shut down some of these factories. We just don't know how much of a hit there, let alone what the demand hit is going to be. So I've kind of given you vagaries so far. One other insight I take from this is it's going to be very unusual, unprecedented really, for a decline in the economy to be centered in the service sectors. If you go back and look at US history, go back and look at recessions 10 years ago, a recession in 1990, recession in 2000, all the declines in GDP occurred in manufacturing and construction. You can look at the data. We've never had more than 1 quarter of slight negative growth in services GDP. And this time around, we're going to have huge declines in services GDP just because of the nature of the shutdown. So this is going to be a very different recession from what we're used to, in which case the numbers that people are floating around, you can't compare a minus 20 or 30, whatever it's going to be second quarter this year, to what minus 20 or 30 would have been 20 years ago or 30 years ago.
Okay, appreciate that perspective. And to your point, I mean, all the economic stuff I'm reading is I've seen Wall Street economists predicting second quarter GDP anywhere from minus 9.5% to minus 34%. Right. And on top of that, they used, we're in the letters of the economic recovery, right? Is it a V-shaped recovery or a U-shape or even an L-shape where it doesn't recover? recover. And to your point, Mike, it's all speculative. Nobody really knows. We don't know when we're going to hit kind of peak cases, so you have to speculate. So as we kind of, as an economist, as you're looking at this, what are kind of the key factors or data points you're going to watch then to kind of determine how severe, the downturn could be and how quick the recovery could be? What are kind of those key sensitivity points?
Well, let me add one other thing, which might answer your second question, but maybe answers the first two. We're dealing at a combination of a supply shock and a demand shock. So in the 2008 recession, the banking system was hit, housing was already in free fall, and then people panicked. Here we've got some panic in the markets. We're going to have a demand shock from people losing their jobs and income, but we've also got a supply shock, and a lot of these declines are forced closures by the government. So it's another different nature of this recession, assuming it is a recession, compared to what we've seen in the past. I think the forced shutdown nature of it argues for more of a V-shaped on the other side. Okay, so call us optimistic if you like, but when these quarantines are finally done and we go back to business as usual, we're still going to have the same platform of an economy that we had before the virus. The issue is how much of it can we utilize? How much are people going to want out? And I think, I'm going to want to go to a restaurant and play some golf and go to a Dodger game. And there's going to be a lot of people out there that going to want to do the same thing. The facilities are going to be available. The government's sending out cash to try to make sure that people can avail themselves of this stuff. So I'm still thinking that that will be a V-shaped type of recovery when it happens. You asked me what I'm looking at. The economic data almost aren't going to matter. And what difference is it going to make whether it's 30% or 40% or 20% down on second quarter GDP? We're not going to have that number till July 20th. Yeah. What's going to get people out there spending money again is when the virus counts decline. So probably the most important piece of quote unquote economic data are these virus counts and when they get low enough to let people start resuming a normal life or something like a normal life.
Sure. Okay, that makes sense. To your other point there on the stimulus checks are going to be going out, and so now people are going to have a little bit of extra money that are out there. I was actually talking to an equity portfolio manager the other day, and their kind of comment was the stimulus, all it's doing is really buying time. It's not actually creating incremental economic value. There's no velocity to that money. I'm not sure if I agree with that statement or not, but I'd be curious your perspective on that.
So you're asking, is there going to be inflation off this?
Well, is it really going to be a stimulus to the economy, or is it just helping people pay a utility bill that they can't pay because they don't have a job?
Well, stimulus is always measured relative to what? You would hope if there hadn't been any of these checks sent out, you would hope spending would be higher than it would be if there's no checks sent out. I think this is frankly not the most effective way to run economic policy, but we're in an emergency right now. They're doing everything that even has a chance of working. You hope it has some effect somewhere, and in 10 years, we can worry about how efficient this stuff was and if there was another way to do it. Right now, I think it's fair to say that they're throwing a lot of you-know-what up against the wall and hoping some of it sticks. And probably the main thing here, we worry about people's balance sheets. Again, we're worrying about the economic platform. So we've got a restaurant down the street, and if the owner goes out of business, that restaurant's still going to be there. People like to go there, but it's going to take a while for somebody to get it up and running. So it'd be easier for the economy to resume operations if we could keep these companies afloat so that they can rehire their workers and reopen for business quickly when the time comes. If a lot of these folks go out of business and file bankruptcy and you have to transfer the assets, that's going to retard the recovery. So probably job one for getting a V-shaped recovery going is, again, keep these businesses afloat. Politically, that's one of the things people are complaining about, and yet I think some people at least, but I think they're being short-sighted about that.
Got it. And kind of while we're on the topic of kind of that stimulus plan, obviously $2 trillion, that's about 10% of US GDP. Thinking beyond this and longer term, is this really going to put long-term strains on the economy now that we've added another deficit of another 10% of GDP?
So the debt. Something to think about. Let's get through the crisis and worry about that later.
Sure.
It's going to be more of a burden on taxpayers, sure. It's going to be a problem in the near term. I worry, will there come a time when the Treasury's issuing this debt and people refuse to buy it? That's not on the radar screen now, and hopefully that won't be an issue, but that's, I guess, the one thing that kind of gnaws at me in the back of my mind. Some of the readings I've done, we go back to World War II, and at least people have claimed that toward the end of World War II, the government was really in danger of running out of money. People weren't buying these war bonds, and fortunately, we don't have that problem right now. Hopefully we won't, but again, something to think about.
Got it. Appreciate that. The big news today was the 6.6 million more jobless claims. I guess over the last 2 weeks, that's 10 million. I'd just be kind of curious your take of your other comment of the short-term data doesn't really mean anything. It's about kind of when we get out of this social isolation. So how do you put 6.6 million jobless claims in context?
Good question. I talked earlier we talked about the leisure sectors that are getting hit hardest by this: air travel, recreation, hotels, and restaurants. About 7.5% of GDP, about a little bit more than that share of jobs. So they by themselves have 13 million jobs. So these sectors are, down to 20% capacity utilization. If these sectors shut down, that'd be 13 million jobs lost right there. So hopefully that doesn't happen, but those are the kind of orders of magnitude we're thinking about. I'm going to quote a friend of mine. I'm going to steal from a friend of mine, Tom Porcelli at our Royal Bank of Canada, just put out a piece about an hour ago, where he emphasizes that these jobless claim numbers are seasonally adjusted. So you guys are in Chicago, when it's 35 degrees in Chicago in March on a seasonally adjusted basis, that's 80, right? Because the average is usually 20 or something. So he points out that this is the time of year when usually layoffs are on the decline, but we're obviously in an unprecedented situation. So we've had a total of 9 million unemployment claims over the last 2 weeks on a seasonally adjusted basis. Who knows? And we could look it up, but we'd have to look up what the actual number was before seasonal adjustment, because the seasonal factors that are applying to these are meaningless. Typically we're in an environment where, the number gets seasonally adjusted up to 300,000 a week, and maybe the unadjusted number is 150,000. So maybe this 9 million number was really only 3 or 4 million seasonally adjusted upward. I'm speaking from ignorance, but it's worth pointing out
Sure.
This is probably not an accurate representation of how many layoffs there actually were in the last 2 weeks. We're going to get a job number tomorrow that will only partially reflect the virus, if anything. These are monthly data supposedly, but they really cover the pay period that covers the 12th of the month. So if your employer has weekly payroll, he's counting the people that were on the payroll in the period that covers the 12th of March. Now, my recollection was the NBA shut down on March 11th, and various governors started shutting things down March 14th, 15th. So it may be that these March job numbers are not going to show any virus effects at all. I mean, they're certainly not going to show the full effects. So we won't know for another month what the job losses are like from the virus. And tomorrow's data might not be too helpful. And again, who knows how much these jobless claim numbers really telling us.
Got it. Appreciate that. I guess shifting a little bit away from kind of the fiscal side of things to the monetary side of things. So the Fed taken aggressive action here in the last few weeks. From my seat, it seems like it's been a step in the right direction to helping to fix the plumbing in the fixed income markets. Maybe not entirely, but it's kind of helped. Do you agree with that? What are you seeing?
I agree completely. The problem today is getting these markets functioning again. So as you said, we're in the bond market. We've been looking at bid-ask spreads for corporate bonds and even some off-the-run treasuries, which are treasuries that were issued a year or two ago, and it used to be a 20-year bond, now it's an 18-year bond. On some of these, the difference between what the dealers are willing to pay for it, the bid, and what they're asking on, the bid and the ask is 1 to 5 price points.
Wow.
So we'll bid 100 and we'll ask 105. before the crisis, it would have been, we'll bid 99 31 30 seconds and we'll ask 101 30 seconds. So instead of a couple 30 seconds of a price point bid-ask spread, we're looking at 5 whole price points. So 100 times larger bid-ask spread than we saw before. This is indicative of markets that aren't functioning. These are markets that are panicked. Dealers are too afraid to take a trade because they don't want to get stuck with the assets in case they can't sell them. This is the kind of thing that the Fed was created to step in and do. And the Fed, as you know, has begun dealing in corporate bonds and making loans directly to corporations in the last 2 weeks. They're really just getting this going, but the markets have responded ahead of time already. I think this is something we didn't see 12 years ago. I wish the Fed had done this 12 years ago. I worry a little bit about I wouldn't want to see the Fed always intervening in the corporate markets, but this is emergency. This is a special occasion. I think it makes sense this time. And I think of all the stuff the Fed's done, this could be the most effective. One more thing, and I'm sorry for the long answer.
No, please.
This is going to help restore some kind of orderly trading to the markets. It's not by itself going to get corporate bond prices back to where they were a month ago. It's going to take the panic premium or the panic delta out of the prices. But there's, on all these corporate bonds, there are default risks now that because of the crisis and because of the shutdown that you didn't have a month ago. So those are still going to be in market pricing, and maybe you can make money over the next year or so. We're looking for good opportunities where we think the market's overpricing default risks. But those default risks are still going to be there. But what the Fed's doing is taking the panic effects out of the prices.
Got it. What's, initially the Fed committed $700 billion of additional capital towards quantitative easing. And then last week they removed that and kind of said unlimited. What's, is that just helping to improve the plumbing, or what do you kind of view as the key benefit of that or key impact of that?
I think a lot of it is announcement effect. The Fed, again, you want to shock people. The investors are numb, they're panicked. You want to get their attention. So big numbers will get their attention. I think in the actual fact, you don't even need that much money. So when you have panic in the markets, as an economist, my favorite allegory is the game we played as kids, musical chairs. When there's 100 people and 99 chairs, there's only 1% chair shortage, but people scramble like mad for that 100 chair, for that 99 chair. If there's more sellers than buyers, it doesn't have to be a big overage. You get crazy trading going on. So we've got those kind of conditions in the market now. I think any Fed action will help. They don't need $700 billion to stabilize these markets, but they're in there doing it with less, which is a start. And maybe the numbers will shock people and get their attention.
Got it. Appreciate that perspective.
The other side of it, again, don't confuse this with quantitative easing. So they're going to be buying bonds. Ideally, they'd be both buying and selling. They want to get on both sides of the market to get this bid-ask spread down. So instead of buy at 100, sell at 105, they're going to buy at 102 and sell at 103. But they're going to be on both sides of the market. So you don't really need a lot of balance sheet to do trading, but you have it available as a backstop. They are also increasing liquidity out there. I don't worry about the inflation side of that for now. This is a panic. They're giving people what they want is liquidity. People don't want cash to spend it. They want cash for safety. And when the panic eases and people are going to have too much cash left over, they're going to start getting rid of it. And that's the time when the Fed will be able to pull that money out of the system. And it's not going to be a problem then, because people unloading all this cash is actually going to put a lot of liquidity into the market. And the Fed will need to take some of it out just to prevent the economy from getting overheated. Fortunately, that's going to be a nice relief when we get there. It's not what we're worried about now. But again, don't worry too much about this stuff down the road. But we want to get through this emergency here first.
That was actually my next question, was the long-term impacts of this. And, if we go back to the initial quantitative easing, right, that was in 08, 09, and it took until 2016, 2015 before they started kind of reducing the balance sheet. So are we kind of stuck in that again, if we're going to have this elevated balance sheet for a number of years?
Possibly so. I think that this recovery could be quicker than the one in 08, 9, 010, but no guarantees that way. And as you say, they really didn't start reversing the quantitative easing until 2014, 15, 16, and they never did much of it. this time around, they're probably not going to start reversing for quite a while unless we just have rip-roaring growth. So a lot of this liquidity is going to be in the system for a while, but people are probably going to want it.
Got it. That makes sense. Okay. Um, that makes sense. Okay. You mentioned earlier, just kind of talked a little bit about the service sector of the economy and kind of how that's going to be different this time around. I mean, do you envision, is this just a different type of recession where it's not manufacturing led, it's service led, or do you see potential structural ramifications for the service sector as a result of what's transpired?
I think it should be relatively short-lived, but Matt, nobody knows for sure on this stuff.
Yeah.
Again, the economy is not going away. It's basically been taken from us. Where this is the slowdowns in the economy are self-imposed in order to try to slow down the spread of the virus. We should be able to get back to a normal life when the virus is done. I hope that's the case. Don't know for sure. Again, you look at the Great Depression as one analogy. There was a Dust Bowl. A lot of the farms had bad times back there, but there was a 50% drop in real GDP during the Great Depression. Maybe 2 or 3 percentage points of that were due to the Dust Bowl. The rest of it was self-imposed kinds of problems. I think we're going to have less long-term self-imposed problems. What I mean self-imposed is just we let the businesses go out of business and go bankrupt, or where they couldn't start up again and people were afraid to start them up again. Now we're shutting them down by force. Hopefully we'll keep these businesses going and we can get back to work more quickly, much more quickly this time than say back in the 30s. Got it.
That makes sense. I think one of the questions we get a lot from our clients, and it was one of the questions that's out here right now on the board, is just, we know there's going to be some businesses that are going to be impacted, likely close. And I think the fear among people is just it's going to be more than just a couple of businesses, but a significant number of businesses. To your point, nobody knows the answer and we're speculating, but how do you kind of in your mind frame what the potential range of possibilities could be?
Part of it depends on the length of the shutdown. So you would hope most businesses could take a 2-week shutdown. Maybe they lay their workers off for 2 weeks, but when the 2 weeks is over, they can get back to work. We're looking at obviously a longer shutdown than that. You hope that these businesses can handle a 1 month, 2 month, 3 month shutdown and get back. But who knows? Some of them can, some of them can't. Probably most of them can, but some of them can't. It's going to depend on the duration, and the other thing, which we still have pretty incomplete data, is how far-reaching are some of these shutdowns and shelters in place that we have. We know that these service sectors, amusements, hotels, restaurants are all but shut down. A manufacturing plant making toilet paper, making foodstuffs, you would hope they're still going, but I don't have really good data on that. And that's part of what I'd like to be finding out the next few weeks.
Got it. Okay. Appreciate that.
I hate to be dealing so much in uncertainties, but we'd be dishonest if we weren't emphasizing, because really the emphasis is on the things you got to know what you don't know.
Yeah. Do you have a sense, have you come across kind of just this understanding kind of the population in the U.S., and we know there are some people that are going to be struggling during this time, of what sorts of people are going to be more impacted by being laid off and not able to make it 2 or 4 or 6 weeks throughout this? Have you seen any data on that?
Well, I don't think you really need the data. It's going to be younger people and people more in more blue collar types of jobs. Some of the buzz I'm hearing, I'm a baby boomer. I'll say that about my age. My friends are calling what's the best time to buy stocks and what investments. They want to take advantage of these low prices. They've got some cash on hand. That even though we're most at risk probably from the virus, we're maybe less concerned about the economic ramifications. The economic worries, I think, are more toward younger workers and blue collar types of workers.
Got it. Any thoughts on just, kind of construction, whether it be residential or non-residential? That is slowing, but does that any real reason to believe that wouldn't come right back like any other segment of the economy?
It should come back pretty well. One of the one of the surprises to us was just how strong the housing market's been over the last 6 months. And I want to use that term advisedly. We never have gotten back to 2005 levels of construction of homes, but housing has been increasing slowly over the last year or so, where I thought it would be going down a little bit. So we were surprised by that relative strength. Building permits, housing starts very strong over the last 3 or 4 months. I've heard that builders are considered essential businesses and that they're continuing to build the product. I can imagine that home buyers are a little worried right now about whether to pull the trigger and buy a home or not, but you know, we're having kids, the population's growing, that need is there. The only reason they wouldn't be coming back is if, you know, if they've lost their jobs. So hopefully with some of the help the government's providing to some of the people that need it, you'd hope that housing can come back pretty quickly.
Got it. Okay, that helps. We obviously have a lot of clients in the Detroit area, and the auto industry is a big part of the Detroit economy. What work or what have you seen on the auto industry, and do you have any worries about this being a longer term impact on the auto industry?
Well, I'd put autos in much the same category as houses. They're big ticket items for consumers. The big three, as you know, did a voluntary shutdown, 2-week shutdown, probably about 2 weeks ago. And from what I'm hearing, they're talking about making it indefinite now. Consumers are going to be leery about buying a car, at least for a while. But you would think when the slowdown and quarantines are over, and you'd hope that car sales could ramp back up, maybe a little more slowly than housing, but you'd hope to see something like a V-shaped rebound in cars. The financing's there. If a worker's got a job or job prospects and he can get the financing help from Detroit, should be willing to buy those cars again. Got it.
And another kind of question that came in here from the panel, any reason to believe that government jobs would be, you know, impacted by unemployment? Are those going to be a little bit more stable than the private sector?
They should be more stable. The issue is, and again, I'm coming from California, where our state budget relies tremendously on the stock market. So much of our state funding comes from income taxes, personal income taxes, and much of our income tax revenue in California is coming from IPOs and stock options, that type of thing. So we're going to have some income problems in California here too long. We've got a nice work, they've got a rainy day fund built up. When we go through that, it's going to be an issue. So I think the main problem for government jobs is whether the government in question has the funding to keep going or not. They certainly need the services, and they've been staying open. So that's the issue, is going to be whether the funds are available. And a lot of that depends on how long this shutdown lasts.
Yep, got that. Okay. Well, good. I think that, I don't know if there's any other kind of questions that people have. Feel free to type those in at this time. I guess one more question. Obviously, since all this started, we've seen interest rates go lower. We've seen gas prices get much cheaper, which is a positive. If I drove anywhere, I'd actually reap that benefit, but I don't drive anywhere now these days. But just kind of, you know, that's in a sense a nice little tax cut for consumers. So, you know, any kind of thoughts on the economic benefit of just lower fuel prices, lower interest rates on consumers?
It's a little bit of help. Unfortunately, we're not doing a lot of driving now. And keep in mind, on the low interest rates, mortgage rates have come down a little bit. Treasury rates have come down a lot. Corporate bond rates are still higher. So there really hasn't been much help to the corporate sector as yet. That's one of the things the Fed is going to try to address. We're hopeful on a lot of areas. Frankly, I wouldn't put too much hope on the interest rate side as yet, because I'm just doubtful that those lower rates are really applicable to many consumers out there as yet. You know, it's still pretty hard to get a mortgage in this country these days, has been for the last 12 years. I think for the lower mortgage rates really to make more help, we'd have to see the government easing up some of these mortgage underwriting rules. And that's, who knows whether that's going to happen or not. That's tougher to do than passing a big stimulus package.
Got it. Yeah. and being tied to the fixed income markets, you may have some good perspective on this. I mean, to your point, it's been hard to get a mortgage for the last 12 years. What I'm hearing is that a lot of mortgage companies are trying to slow down the rate of new mortgage applications because they want to be able to validate does somebody actually have a job or not. And there's so much moving so quickly. And on top of that, when you look at kind of credit card loans, auto loan funding, are you seeing the challenges in the fixed income markets leading towards it being harder for people to get a mortgage, get a credit card, get an auto loan, just because it's harder to securitize those and ultimately fund it?
You know, Matt, I don't think those have been issues so far because if nothing else, a lot of the volumes dropped off. So the car dealers want to keep the sales going. So if anything, the volume of car sales have dropped off. So the volume of car loans has dropped off. So the funding issues are there, but maybe this has helped a little bit that the volumes have dropped so much in some of these areas.
Okay.
And again, I'm speculating now, but that's a sense I get.
Sure, I get that. And I got another good question from one of the listeners. Is there a way kind of for the federal government to just declare force majeure and just kind of put some of that and erase a few months of the private debt? What do you kind of know about some of the regulations there?
Not a whole lot, Frank. So the issue is going to come down to, so whose debt are you forgiving and who picks up the bill? So if General Motors Acceptance Corporation has a car loan to you and the government rules it null and void, it is force majeure. They're basically taking assets away from General Motors. It's helping you as a borrower, but what recourse does General Motors have? And does the government just say they're going to pay it off? I mean, if they want to do that, maybe the easiest thing to do on a legal basis would be to buy the paper from General Motors. And that's some of the facilities the Fed's setting up would allow them to do that. I don't know if they're going to do that specific thing, but that would probably be a cleaner way to get some of this debt off the books than some of the pie in the sky things people are going to talk about, just nullifying 2 months worth of rent or not requiring you to pay your mortgage. The mortgage is a contract between you and the bank, and how does the government step in? I mean, they can do it, but it'd just be a little easier just to buy some of these assets.
Yeah, appreciate that. And last question we have here from one of the attendees is just retailers. What's kind of, small independent retailers? You have any perspective on what may happen to them?
We haven't heard too much about what the government's plans are. Some of the stores are still open. Some of them are being forced to be closed. You would think if the government forces you to close, it should provide you some recourse, but no, I don't have specifics on that as yet. That's the big issue we talked about a minute earlier. Are these platforms going to be available to resurrect themselves when the quarantines are over? For that to be the case, you got to keep these owners in business or able to be in business, and that's one of the things we have to deal with. We're talking about phase 4 of some of these stimuluses in Washington, and I got to admit, maybe I missed what phase 1 and 2 were. I assume phase 3 was this $2 trillion package last time. So they're doing a lot of stuff. Hopefully they'll address some of these issues. And then it's going to get down to, is it a state issue or a federal issue? Like in Los Angeles, the mayor and governor of Los Angeles and California are shutting down the businesses. Is the federal government going to step in and provide some backstop to that? The state probably doesn't have the finances to do it. So these are issues we're going to have to sort out.
Yep. I hear you. Okay. I guess one more just came in. It's a good one. Last question on the oil market. So with all that's gone on in oil prices declining and now a dispute between Russia and Saudi Arabia and even arguably the US, how are you guys kind of looking at the supply demand dynamics in the energy market and how that could play out? Well,
we're looking at the finances of the U.S. oil patch folks, the fracking, the shale oil people. They've been hit very hard last month in terms of spreads. So the spreads of their bonds trading over treasuries have exploded. So there's all kinds of speculation in the markets that these folks are going to be under pressure, are going to have to go bankrupt and sell assets. that's going to be true to some extent. We're looking to find the operators that are going to, obviously, like everybody else, we're looking to find the operators that are going to survive and whose paper is most attractively priced. There's going to be some fallout there. Hopefully the markets are overstating that, and we'll just have to find out.
Yeah, my take on this is more naive than yours, but clearly with the U.S. being the higher incremental cost producer, it's a way for Saudi Arabia and Russia to kind of reduce production in the U.S. Do you guys kind of share that view?
Sure. And that's been, there've been all kinds of articles about that, or the Russians, we're the swing producer. So we're now I don't know if you know this or not, we're now the largest oil producer in the world.
Yep.
And it is relatively high cost compared to just somebody opening up a tap and pulling it out of the ground. But our producers have gotten more agile about being cost effective at ever lower levels of price. I don't know they're going to survive at $20 a barrel, but they can survive at $40 and $50 a barrel. Russia's trying to move it down low enough to knock these guys out of business for good. That's not going to work. The shale's still there. Russia doesn't want to keep prices down at $20 forever. And when it goes back to 40, again, if this operator goes out of business, somebody else is going to buy their properties and go back and start producing at 40 or 50. So Russia's kind of playing a waiting game, but time's probably not on their side, and they can only hold out so long. So
Yep.
Again, it's a waiting game for our producers as well, and maybe some of the backstop funding we might get from the government might be a helper here.
Got it. Okay.
It definitely is a global strategic geopolitical kind of issue here as much as an oil market issue.
Sure. Well, excellent. Well, Mike, we kind of went through a lot of questions. We covered a lot of ground today. I appreciate you sharing all your insight with us. We're privileged and honored to have you with us. And thanks to all those that have come on the call with us and spent some of their afternoon with us. Thank you very much. Thanks, Mike.
It was a pleasure, Matt. Nice talking with you.
Thank you.